Moolla, who's the CEO of Think Markets. As always, Ridwaan, thank you for joining us this evening. Let's start with the movements that we saw on the JSE today. I mentioned it in my intro that it closed marginally in the red. We saw pressure coming through for the resources, some positivity for the industrials today. What would you say were some of the big drivers of the movements that we saw on the JSE?
So I think you pretty much did it just before I joined. CPI. What a nice day to be doing this year, where we can say CPI is at 5.4%. That was just incredible. I mean, that's almost 1% down from the previous month, 6.3 down to 5.4. But we also saw overseas, we saw the UK come out with their CPI figure, and for the first time, that was below 8% as well. So all in all, a very good news for consumers out there. Hopefully tomorrow, it's fingers crossed, this is where you got to touch wood, touch the rabbit's foot, whatever you have to do. Let's just hope we don't see an interest rate hike tomorrow. But having said that, the big movers on the day, yes, resources. Obviously, China's importing. They're not importing that much, especially in iron ore. But the scary thing was, on the green side, ArcelorMittal up 27%. But now, let's just put it into context before we all smile and be happy. That did drop 40% yesterday after it came out with a very, 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 very bad trading update, which spoke about load shedding and quite a few other things, like its high debt is actually going to put the company into a loss. But it was a nice green day for them. Then, unfortunately, following on with that bad news, Pick n Pay came out with a trading statement, which saw that share price fall just over 8%. So had some good news, but there was also some bad news, unfortunately, as well.
Yeah, some bad news indeed. And we'll get into those company-specific updates in a moment, Ridwaan. But I want us to reflect a little bit more on the UK inflation. Like you said, it came down to below 8%. So that means that aggressive nature that central banks have been approaching globally is starting to be reflected in the economies, us included. And I suppose with the aggressiveness that we've seen over the last 10 or so hikes, we're probably going to see a continued tapering down of inflation as we absorb those big rate hikes that we saw over the last consecutive meetings.
100% correct. But the thing to understand is that you're going to start seeing obviously currencies like the dollar and the pound, they've been weakening. And we saw that today again, where you can see the exchange rate even between the pound and the rand, that came down slightly as well. And that's because with inflation obviously coming down, and therefore we're not going to be seeing aggressive interest rate hikes, South Africa does become a very good market for people to put cash in, because they're going to earn a much better interest rate here than they would in the US or in the UK. So those things all helped us with our exchange rate, helped it go down a bit. But it also means that we could be seeing a bit more investment coming into our country as well. And those are all really, really good news. But the big thing is, like you're saying, inflation is now getting under control. And we're seeing the benefits of all these wonderful interest rate hikes. So that's why we're saying, come tomorrow, literally right now, the Reserve Bank has the opportunity to just put a pause on the interest rate hikes, and let's see how things go from there.
Let us breathe for a couple of months is what the Reserve Bank needs to do, Ridwaan. Before we get into those company updates, I just want to reflect on the price of Brent crude. Is it solely a China economy slowing down story that we're seeing it at $80 a barrel now? It's quite high, and I suppose there are fears around the levels of supply when the guzzlers like China are not needing as much as they traditionally would.
Well, it's a bit twofold. It's that, and obviously the big thing is, Russia has unfortunately reduced its supply. So that's been also the reason why you're seeing that oil price go up the way it has. The question is right now is that, can it actually go above the $80 mark and maintain it for a while? Or will Russia and them come to the party a bit more and start looking at saying, okay, let us increase it a bit? Remember, Moscow, it did say that it aimed to reduce its third quarter crude export. I think it was by about 2.1 million tons. So that's a lot. And I mean, it's going to be where the Saudi and the OPEC nations and them can come in and cover that demand. But if not, then yes, we can see it go up a bit more. But to be very honest, I mean, not many of us are seeing it going above that $85 mark unless something really drastic happens.
Yeah, let's get into those company updates now. And the picture you painted about that miner, the 20% fall in results that they're planning to see, Ridwaan, and they're saying higher operating costs and load shedding is going to be having an impact on those results. This is a completely different story that they were giving to us just over a year ago with that commodities boom and the tax revenue that they were able to give to the fiscus. Your outlook on it, but also on the miners in general, as we see a downturn in commodity prices in general.
So ArcelorMittal, I mean, it was actually in February that they actually said that they would be, you know, they had a very positive outlook. Unfortunately, all of that has just changed. Yes, load shedding, obviously our rail infrastructure. But the big thing for them was the fact that they have quite high debt. Now, any company, especially in the mining industries that have high debt, with the interest rate hikes that we've also had, is just piling on the pressure onto them. So right now, you've got weakening prices. I mean, remember, you're looking at gold below $2,000 for a while now. All of these commodity prices are going to impact our mining companies. And for a lot of us, I mean, for people like myself and that there, it is a bit problematic because it's going to see these mining companies take a bit of a knock in their share price, especially in the short term. And the big question is going to be is how they're going to recover from this. Now, obviously, load shedding, there's not much they can do. They can only hope and pray that things improve there. But they're going to have to start looking at other cost-cutting measures that could impact, obviously, jobs as well. So we've got to be very careful of that. And we've got to try and see how these mining companies are going to obviously, especially over the next few months, are they going to tackle the load shedding, the Transnet issue, and obviously the higher interest rates. That's going to be the key right now. And there's a big focus in South Africa to seeing these companies with their trading statements and their results that are going to be coming out. So companies in debt right now, bit of a problem, especially in the mining sector. But I mean, you've also got some really good cash flush companies around that are obviously going to be able to cope through this entire, downturn in the commodity sector.
Retailers, Ridwaan, on the back of Pick n Pay's trading update, they're also not immune to the pressures that consumers are facing, highlighting a myriad of issues that are persistent in this trading climate. Your thoughts on that trading statement, and I suppose the short to medium term outlook for retailers in general? Sure, we're seeing a tapering down of inflation, but those higher operating costs are persistent because of fuel prices and other pressures that are currently in the economy, including load shedding.
So the thing from you and Pick n Pay's results, I mean, remember the share, it wasn't good. I mean, they also said the H1 24, is going to be decreasing by more than 20%. I mean, that's the earnings per share, headline earnings per share. It's all looking bad. And one of the things that they've highlighted is, I mean, just in this 4-month period, March to June, they were talking of spending 300 million rand in diesel costs. They then also going to have to take on a further 250 million anticipated costs for restructuring. Now, all of these things are going to hurt them in the short term, but obviously they are looking at then saving almost 300 million with the restructuring going forward. But that's only to come further down the line. So what Pick n Pay's results really and truly said was, we've also seen, inflation, especially in food, over 11%. But yet they've not really increased their prices by 11%. They've really and truly tried to keep the price increase much lower. And that obviously did impact them here in the short term. But the big thing right now, when I'm looking at these results, is what does this say for consumers? Consumers still are going into Pick n Pay. They're still doing well. I mean, there's 4% growth that they've seen in the South African business. They've seen more than 15% in the rest of Africa. And it's saying that, look, they've done well, but now they obviously just need to just get through these next few months and it's all the rest of this year, especially with regards to the costs increase on diesel and that, and the restructuring. And I think going forward from next year, we're going to be seeing much better results actually coming out of the companies like Pick n Pay, even ShopRite, Woolworths, and those type of things, where people, because consumers are obviously needing to buy food, whether we like it or not.
That's right. We do indeed need to keep ourselves nourished. And you're absolutely right. 20% was Pick n Pay's forecast for a profit drop. And I actually said it was Hasselo. Excuse me for that. Anyway, Ridwaan, thank you very much for joining us this evening. That is Ridwaan Moolla, who is the CEO of Think Markets, wrapping up the market day that was